In this chapter, we're going to be covering the next set of steps in the accounting cycle. These steps are the adjusting entries, the closing entries, and then we're going to talk about some related things, including preparing the adjusted trial balance and preparing the financial statements from that data. So, why do we need to worry about adjusting entries? One of the main reasons is that we are talking about the accrual basis of accounting here, and this, as we've talked about before, requires that we record revenues when they're earned, regardless of whether the related cash transaction has taken place or whether it will take place later on. Same with expenses. We record the expenses when they're incurred, regardless of when the cash will change hands. Now, if we weren't concerned about just reporting things for 1 month or 1 year, if we're just concerned about when something is earned over the entire life of the company, there would be no need for adjusting entries. What we're saying there is that the cash basis of accounting and the accrual basis of accounting, if you look at the entire life of the company, the same total revenues will be counted, the same total expenses will be counted. It's all about timing. When are they counted? Are they counted in this year or next year, or this month or next month? So, because we're focused on the accrual basis of accounting and we're concerned about how things are reported in a particular period, it's all about proper cutoff, proper timing. So, this slide here just talks about the accounting period itself. We know we could have several types of periods. We could do monthly reporting. Publicly traded companies need to do quarterly reporting. Some companies might want to do semi-annual reporting, and certainly all companies would do annual reporting. So again, we have to compare the accrual basis of accounting versus the cash basis. The accrual basis of accounting is when revenues are recognized when they're earned. So whenever we provide the service, whenever we sell the product, anything we need to do to earn that product, earn that revenue, regardless of whether we've actually received the cash or maybe we've even received cash ahead of time. It's all about timing. We earn it, or we record it, we recognize it when it's earned. And with expenses, they're recognized when they're incurred, which means we've used up the benefit related to that expense. We've used maybe some asset up and we're using its benefit. Or, for example, with salaries expense, we've used the benefit of our employees working for us and providing service to us, so we count it as an expense. Again, with the cash basis of accounting, everything is concerned with when did cash change hands. That's the only thing we need to worry about for recognition. Of course, the cash basis is not allowed under GAAP, so if you have a publicly traded company, they must use the accrual basis of accounting. So let's take a look at how this differs. Kind of an extreme example here, but it really will show how the timing is all that's important. So in this company, or this example, Fast Forward paid $2,400 for a 24-month insurance policy beginning 12/1/2011. So they paid for all of it in 2011, right toward the end. On the cash basis of accounting, that's all we're concerned with. When did they pay for it? So all $2,400 will be recognized as insurance expense in that year. And even though we're getting a benefit from that insurance expense for 24 more months through 2012 and part of 2013, we're not going to count any insurance expense there because we've already recognized all the insurance expense under the cash basis of accounting. Under the accrual basis of accounting, we're concerned with when did we use up that benefit. We don't really care when we paid the cash, whether we pay it early, whether we pay it later. We're concerned with when did we use the underlying benefit. If you take the $2,400 divided by the 24 months, you get a nice round $100 of insurance expense that should be recognized every single month. So here we have December of 2011 just gets $100. The year of 2012 gets $1,200 because there's 12 months using that benefit. And 2013 only gets $1,100 because there's 11 out of the 12 months that are using the benefit of that insurance. So it's all about when is the expense incurred, when is the benefit used up. So we're going to talk about these adjusting entries here, and we're going to see how they look, how they classify, how they get classified. The whole goal of an adjusting entry, it has two main goals. The first one that's stated here is that we want to bring the asset or liability account to its proper amount. What we're talking about there with a liability, for example, we could have accounts payable. For an asset, we could have accounts receivable. Those aren't the only ones we could have, but those are just a couple examples. The other side of this is that we also want to bring the revenue or expense amount to its proper amount, or the revenue or expense balance to its proper amount. So again, we'll see that both of these come into play. In fact, every entry, every adjusting entry here has to have at least an asset or a liability, and it has to have a revenue or an expense. So you're adjusting both the asset or liability and the revenue or expense to the proper amount to recognize what actually happened regardless of what cash changed hands. So we have two main classifications of adjustments, and then we're going to find out that they break down into two more subclassifications. So the first adjustment type, they're referred to as deferrals. They're often noted as deferrals. This is where we're trying to defer the recognition of revenue or expense until a later time when we've actually earned it or incurred it. So the cash changed hands now, early, and we have to record the cash transaction, but we can't record the revenue or expense yet because we haven't earned the revenue, we haven't incurred the expense. So here with a deferral, the cash is changing hands first, and we will have that journal entry. That part is not the adjusting entry. It's later on when we do earn it or incur it that we have to adjust those balances. The other side of this, the other type of adjustment classification, is where the cash changes hands later. So we have something now that we know we've earned revenue, we know we've incurred expense, but the cash won't change hands until later on. We have to force the recognition of revenue or expense right now, and then later on we'll handle the cash when it's paid or received. So let's go back to the prepaid or the deferrals. They're often referred to as deferrals. So we have prepaid or deferred expenses. And, let me go back here. The deferred expense, a couple examples here. One of them would be prepaid rent. So if we prepay as a tenant, we prepay rent, maybe a year or more, to our landlord, and we're going to use the benefit of that rent up over the next 2 years. We're not going to incur it all as an expense right now when we paid it under the accrual basis of accounting. Instead, we're going to reflect that we paid cash, but we're going to turn it into an asset. We're going to call that a prepaid expense, like prepaid rent. The example we had earlier was prepaid insurance. Same idea. We're prepaying an expense, we're prepaying insurance, and we're going to call that an asset. So even though the name is prepaid insurance expense, it's basically an asset. The prepaid is the important word there. We've paid the cash, we're going to use it up over time. The other side of this is the unearned or deferred revenues. So here is when we've received cash ahead of time before we can count it as a revenue. For example, we might be the landlord in this situation, and our tenant has paid us 2 years worth of rent in advance. So we're not going to count that all as revenue right away because we haven't earned it. It's going to be a liability. That unearned revenue is called a liability, and the reason for that is that if they pay us that money in advance, we owe them something. We either owe them the benefit of staying in that building for the next year or two, however much they've prepaid, or if we can't do that for some reason, we owe them their money back. The other side of this, we'll look at the details. Oh, yeah, by the way, let me back up here. The prepaid or deferred expenses. So I talked about the rent expense or insurance expense. Another example, two other examples, would include supplies. So if we buy supplies, then it's an asset until we use them. When we use them, that's when it turns into an expense. So we're deferring that expense until we actually use the supplies. Even though we paid cash early on to buy the supplies, now we're actually going to use them up. We're going to convert them into an expense. Depreciation is the other example, and we'll see that in just a bit. So now let's move over to the right-hand side. We have our accrual type entries. So we have accrued expenses, sometimes referred to as accrued liabilities because the entry deals with an expense and a liability. Then we have accrued revenues, sometimes referred to as accrued assets, because we're recognizing the revenue and it is an asset at that point as well. So accrued expenses, one good example here would be salaries expense, where we know that employees have worked for us for a few days and payroll isn't until the beginning of the next period. But we need to force the recognition of an expense in this period because they've earned that money from us. And we've used up the benefit. That's maybe the more important thing. So we're going to recognize the expense, which at the same time recognizes the liability. And we'll see that in some examples here. Then we move over to the other side, accrued revenues. There are a couple examples here. One of them is simply interest revenue, where we recognize the fact that we've earned interest revenue just because we've lent someone money for a certain period of time. So we know we've earned the revenue, but we're not going to receive it until the next period. So what we do is we accrue that revenue. We force the recognition of it because we've done everything we need to do to earn it. We don't need to wait till we receive the cash to record it. We just need to wait till we earn it. And with interest, the passing of time earns that money for us. We'll see another example there as well. So with the prepaid or deferred expenses, again, insurance is a good example. The resources or the cash was paid before we've actually used up the benefit, before we actually can count it as an expense. So that initial transaction where the cash is recorded, we would, since we're paying, we would credit cash to reduce it, and we would debit some asset, a prepaid, in this case, insurance. So what happens here is when we debit that asset, we have an unadjusted balance. Here's where it is. Here's the benefit. Over time, we're going to credit that to reduce the asset, and we're going to debit the insurance expense. So it gets used up, and it gets moved from an asset to an expense through a normal adjusting journal entry. So here's an example. During 2011, Scott Company purchased $15,500 of supplies. Scott recorded the expenditures as supplies. On December 31st, a count of those supplies indicated $26.55 on hand. So first of all, we had an initial entry. During 2011, we would debit supplies for $15,500 and credit cash. So that's fine, but that's not the adjusting entry. Now, at the end of the period, which is where the adjusting entries will always fall, we figure out we only have $26.55 left. So we've used up some. We had $15,500. Now we only have $26.55. So we must have used $12,845 of those supplies. So what happens here is we've reduced the supplies balance by crediting that asset, and we debit supplies expense to show that we've now used it up. So this gives you the ending balance of supplies. We had $15,500 on the debit side. We credited it for $12,845, which brings us to a debit balance of $26.55. Depreciation is very similar to the idea of the supplies. The only difference is it's longer term, and we have a slightly different calculation, or slightly different calculation and journal entry. So depreciation, which will be covered in a later chapter in more detail, this is where we take the cost of a long-term asset, whatever amount we paid for that asset, and we spread it out over its life, which could be several years. We don't want to record it all as an expense in year one when we bought it, because it's going to benefit us for several years. We're going to use that benefit up over several years. So the calculation to get this, since it's not like supplies where we can directly identify how much of that asset is left, we can't count pieces of an asset, of the fixed asset, like we do supplies. So instead we have to approximate, or we have to estimate the amount or the percentage that we think we've used up each year. The method we're going to talk about here is the straight line depreciation expense. This is where we're taking the asset's cost minus the salvage value. That gives us what we call depreciable cost. This is the amount we want to depreciate out. Now, a couple things to mention here. Salvage value has a few names. Salvage value, scrap value, residual value. We're basically saying here's the amount that we think it's going to be worth after we're done with this asset. So we're going to take that, we're going to divide it by the useful life. That'll give us an amount per year to depreciate. So let's look at an example here. On January 1st, 2011, Barton Incorporated purchased equipment for $62,000 cash. The equipment has an estimated useful life of 5 years, and Barton expects to sell the equipment at the end of its life for $2,000 cash. Let's record depreciation expense for the year ended December 31st, 2011. So we have the $62,000 historical cost, the actual purchase price, but we don't want to depreciate the whole thing. We subtract out the $2,000 that's going to be left over at the end of this asset's life. That gives us $60,000 depreciable cost. Divided by 5 years gives us $12,000 per year. Now the journal entry, here's where it's different. With supplies, we debited supplies expense, we credited supplies, asset. With depreciation, it's a little bit different. We still debit an expense account called depreciation expense, but the credit does not go to the equipment account. It doesn't go directly to the asset. Instead, we credit an accumulated depreciation for that asset. This accumulated depreciation is a contra asset account. It offsets the normal asset's value. Contra just means offset against. It reduces that asset's value. So it's the opposite of an asset, essentially, and it has the opposite normal balance. An asset has a normal debit balance. An accumulated depreciation contra asset has a normal credit balance. So since we're crediting this, we're basically increasing it. Here's how it's going to show up on the balance sheet. We have our equipment, our asset, less the accumulated depreciation. So minus $12,000 gives us a net book value for that asset. So at this point on our books, this asset is worth $50,000. So now we'll move on to the other side where we have the unearned revenues. This is where we've received cash. We've received a lot of cash up front, and we have to recognize that, but we're not going to count the actual revenue until we earn it over time. So the example they give us here is season tickets. So as a university or a football or basketball team in this case, we have season tickets. We receive a lot of money up front, but we can't earn it, or we don't count it as earned until we actually provide the service, which for a basketball team is providing entertainment to the fans, to the ticket holders. So what will happen is initially we'll debit cash because we received cash, and we'll credit a liability showing that we owe something down the road. Hopefully it's that we owe that service to our ticket holders. So that's where the unadjusted balance falls. But over time, we're going to debit that to reduce the liability, and we're going to credit revenue. So we're basically moving it from a liability to a revenue to show that we've earned it. So for an example, on October 1st, 2011, Ox University sold 1,000 season tickets to its 20 home basketball games for $100 each. Ox University makes the following entry. We debit cash for that $100,000 that we received, 1,000 season tickets times $100 each, and we credit unearned revenue for $100,000. It's a liability. So keep in mind there are 20 games. On December 31st, Ox University has played 10 of its regular home games, so 10 out of the 20, half, and we won 2 and lost 8. That part really doesn't matter. That has nothing to do with how we account for the revenue. We don't earn more when we win or earn less when we lose. So we're debiting unearned revenue to show the amount that we no longer owe because we've earned it. That was half of the $100,000, so it's $50,000. We're crediting the revenue to show that now we've earned it. We're moving it from the liability to the revenue. Now we'll move over to the right-hand side of things with the accrued expenses. So these are costs that we're going to incur in a period. We have to force the recognition even though they haven't been paid yet. So there is no cash transaction taking place right now. That's going to happen later on. So here, just an example. We're about one half done with this job and we want to be paid for our work. So the employers, they've provided benefits to us, and the employees have provided benefits to us, and we as an employer have to recognize the fact that there's this benefit that has not been recorded yet because we're not going to pay it until a later period. So what happens is we're going to debit the expense to recognize that we do understand we've used up a benefit. And we're going to credit the liability, which would be salaries payable, to show that we owe some money down the road. Martin Incorporated pays its employees every Friday. Year end 12/31/11 falls on a Thursday. As of 12/31/11, the employees have earned salaries of $47,250 for Monday through Thursday. So what happens here is we look at the month of December. That's our last month. On 12/25, which is obviously Christmas, I'm not sure why they'd get paid right on Christmas, but the last pay date was 12/25. The next pay date won't be until January, maybe 3rd, whatever that happens to be. So it's not going to be till January. And we have to record, and actually it'd be January 1st. Yes, it'd be January 1st would be the next pay date. There's a bigger space than there needs to be here. So December 25th was the last pay date. January 1st will be the next pay date because they pay them every Friday. 12/31/11 is the year end. Now that year end is basically, it includes Monday, Tuesday, Wednesday, and Thursday of that week. So it includes 4 of our 5 days for that week. Even though we're not going to pay cash until the next month, the next year, we want to record the expense that we've incurred up to 12/31/11, up to the end of this period. So here they tell us that amount, $47,250. So it's a pretty easy journal entry there. We debit salaries expense for that amount, and we credit salaries payable to show that we owe that money. Down here, this is just showing that we probably have salaries expense for the rest of the year, and now we have this total balance overall. The last adjusting entry here is the accrued revenues. So here we have a few different examples for this, but the one we're going to use right now is where Smith & Jones CPAs had $31,200 of work that was completed but not yet billed to the clients. So we've earned it, we just haven't billed it yet. Now the reason this might happen is some companies have a policy where they bill on a certain day of the following month. So for example, they may not bill until the 15th of the following month for all services they provided in that previous month. But we still earned it. That's the key thing. So the adjusting entry here is really the exact same entry we would make if we did bill them. It's a debit to accounts receivable to show that we owe the money, or we are going to receive the money is owed to us, and a credit to service revenue to reflect the fact that we've earned that revenue. So that's all we're doing there. Now, with the accounts receivable, again, we probably have other receivables from other services, and we're just adding this in. We're debiting it to add it in. Service revenue, same thing. We've probably got other revenues throughout the year. Now we're just adding this amount in to adjust the balance. So let's take a look at this chart here and understand how this all works out. We have our 4 types of adjustments. We have our 4 entries for those adjustments. And let's take a look at what would happen before we made the adjustment. In other words, if we did not make this adjustment, we would be in error. Our balance sheet accounts would be wrong, and our income statement accounts would be wrong. So let's take a look at why, or how they would be wrong. With a prepaid expense, we debit an expense which increases it, and we credit the asset which reduces it. So before we increase that expense, the expense is going to be too low. It's going to be understated. Before we decrease the asset's going to be too high. It's going to be overstated. Now let's tie expense into equity. We know that expense reduces equity. It has an inverse effect. So if the expense is understated, that means our net income was overstated because we had too little of an expense. So our net income was overstated and our retained earnings was overstated, which means that our overall equity is going to be overstated. So let's look at unearned revenues. We would debit a liability, we would decrease it, and we would credit the revenue to increase that. So before we decrease the liability is going to be overstated. Before we decrease the revenue, or before we increase the revenue is going to be understated. Revenue has a direct impact on equity, so if revenue is understated, equity is going to be understated as well. With the accrued expenses, we would debit an expense to increase it, and we'd credit the liability to increase that. So before we increase the expense is going to be understated. Before we increase the liability, it's going to be understated. And if an expense is understated, that means our net income was too high because we didn't reduce it by enough expense, and our retained earnings was too high, it's overstated. Therefore, our equity overall is overstated. With accrued revenues, we're going to be debiting an asset to increase it, crediting the revenue to increase that. Before we increase the asset's going to be understated. Before we increase the revenue is going to be understated. And again, if revenue is understated, net income is understated, retained earnings is understated, therefore overall equity is understated. So now we've gone through all those adjusting entries, and we're going to go back to the trial balance and see how this works out. So this is called a worksheet. Some companies use this, some computer programs might show you this. But we start off with the trial balance, which we've talked about in an earlier chapter. All the accounts have a particular balance. Everything balances out. Total debits, total credits, they balance out. Then we add in all of our adjusting entries. So wherever they went, we had a debit to accounts receivable. This is not a balance, by the way. This is just the entry for that particular adjusting entry. We had $100 for prepaid insurance. So you can see all of these. The total debits and credits for those entries must balance out as well. Then we get the adjusted trial balance, which is simply the unadjusted trial balance plus or minus the adjusting entries, depending on whether it increased it or decreased it. Now, again, our total balances, total debits, total credits, they must balance out as well. So now we have the actual adjusted trial balance here. We have all of our accounts with a debit balance or a credit balance, and we're going to start preparing the financial statements, starting with the income statement. We'll find that for the most part, the preparation of these financial statements is simply pulling over the proper amounts from the adjusted trial balance. There are a couple we need to calculate, but for the most part, it's just pulling amounts over. So for revenues, we have all of our revenues listed. We'll pull those balances over. Same with all of the expenses. So out of your adjusted trial balance, only your revenues and expenses get pulled over. You get a subtotal of all your total expenses, and you get a net income figure. Then we could prepare the statement of retained earnings. If you remember the flow from this statement, we start with the beginning balance of retained earnings. We add in net income from the income statement. And then the only thing that gets pulled over from the trial balance is the dividends, the balance of dividends. That gives us the ending balance of retained earnings. Now we're going to prepare a balance sheet, and this uses the assets, liabilities, and the owner's equity. So assets and liabilities come from the adjusted trial balance. We pull those over. And then our equity, the common stock, that gets pulled over as well, which you can't really see from this screenshot. The common stock likely wouldn't have changed. It could change during certain years if the company issues more stock. But the retained earnings balance comes over from the statement of retained earnings. You don't want to pull retained earnings from the adjusted trial balance because that would be the beginning balance, not the ending balance. So now we've talked about the adjusting entries. We're going to deal with the closing entries here. So once we've completed the financial statements, the goal is to close certain accounts out so we can start the next year fresh from a zero balance. So certain accounts that are known as temporary or nominal accounts, they give us the data just for one period. For instance, our revenue accounts, our expense accounts, and the dividend account, they give us the information for just that one period, and we want to start the next year fresh from zero. There's an account called the income summary account that some companies, some computer systems use. It's just a very temporary account that it takes your revenues minus expenses and it gives you a net income figure. We'll talk about both methods here. These accounts, these temporary accounts, are closed at the end of the period so that we can start the next year fresh. The other accounts, the remaining accounts called permanent or real accounts, they don't ever get closed until the company completely goes out of business. Instead, they carry their balances from year to year. These are our balance sheet accounts, our assets and liabilities, and retained earnings. So we have a process here for the closing entries. As far as the order is not really as much of a concern, but this is the most logical way to go through it. So first of all, we would close the revenue accounts out. By the way, when we say close, we're talking about taking the balance. So if it has a credit balance, for example, we're trying to zero it out, which means we have to debit that account for the same amount to zero it out. Then we close the expense accounts, do the same thing. It starts with debit, so we have to credit it to close it out. They get closed to one of two accounts. Under this particular textbook, this methodology, we would close them both to the income summary account, and we then get a net income figure. So it's just a check figure. You can compare it against your income statement, and yes, everything matches. Then you would close the income summary account to retained earnings. The other method is you can just close revenues and expenses directly to retained earnings. That'll save you a step. Step 4, the last one, we'd close dividends out to retained earnings as well. Because remember, dividends reduce retained earnings. So let's take a look at this process and how it would actually work. We have expenses, revenues, income summary has nothing in it yet, and then we have a retained earnings balance. So we're going to close the revenues first. They have a credit balance, so we're going to have to debit them for that same amount to close it out. So we're going to debit revenues, and the credit to that entry goes to income summary. With expenses, they start with a debit balance, so we have to credit them to close it out, and the debit to that entry goes to income summary. What you can see here, let me back up, you can see here under both cases that when we close something out, we're basically moving its balance to another account. So we end up moving the $25,000 credit to become a $25,000 credit under income summary. Same with expenses. We're essentially moving the debit balance of $18,100 in expenses to become a debit balance of $18,100 under income summary. Now we have a $6,900 credit balance in income summary. We're going to close that out. It's a credit balance, so we need to debit that to close it. So we debit the income summary, we close retained earnings, and now we want to close the last one, dividends. It has a normal debit balance, so we're going to close it out with a credit, and the debit to that entry becomes a retained earnings debit. The last step here is simply to determine the ending balance in that account in retained earnings, $11,900 if you do the math here. So we've closed everything out. We have one more trial balance. It's the third trial balance we're dealing with. This is the post-closing trial balance. It's the same idea. We're getting the balance of each account and bringing it forward. The main difference is that many of those accounts will no longer have a balance. All those accounts that we closed should be zero, so they really shouldn't be listed on this trial balance. The trial balance only lists accounts that actually have a balance. So we should have assets, liabilities, and the equity accounts, with the exception of dividends. So this particular slide goes through the entire accounting cycle. This is what we've been covering for the past couple of chapters. The order is important, but as far as where each step is, what I mean by that is the number of steps. That is not. Different texts, different instructors, they use different methodologies here. Sometimes they'll merge a couple of these steps together. The order itself, if you understand kind of how things flow, that's what's important. So we analyze transactions, we take a look at them, figure out what happened. We create a journal entry. We post that journal entry to the ledgers. We prepare the unadjusted trial balance. Then from that, we use our adjusting entries to give us an adjusted trial balance. From that, we prepare our financial statements, and then we go ahead and close out everything to start the next year fresh. Just to double check, we prepare a post-closing trial balance, and that's usually the last step. Some companies decide to use reversing entries. It's completely optional. What happens with a reversing entry is that you're reversing the adjustments. The whole purpose of an adjusting entry was to give you good data to prepare financial statements. If you don't like those adjusting entries sitting in your books, you can reverse them, and then deal with the actual transactions as they occur when the cash really is received. Now, again, next year, if you reversed this adjusting entry, next period you would have to take a look at what happened again, and you might have to do another adjusting entry before you prepare your financial statements. So it's completely optional if companies want to use that. The next topic here we have is a classified balance sheet, just kind of talking about that. Now, the term classified doesn't mean super secret, top secret. We're not talking about that classified. We're talking about having classifications. So it's categorized. It's a categorized balance sheet. That's another way of putting it. So we still have the assets, liabilities, and equity. We're going to break it down, though, between current and non-current for both assets and liabilities. The general breaking point is 1 year. So if it's going to be an asset that's used up within a year, then that would be a current asset. If it's going to be used up in more than 1 year, that'll be a long-term asset. Same with liabilities. Is it going to be paid in less than a year, or is it going to be paid in more than a year? Some further classifications for our assets, for our long-term assets. We're going to classify them as plant assets, sometimes referred to as property, plant, and equipment, or fixed assets. These are tangible physical assets that last for more than 1 year, and we can use them up in our actual operations. We can physically use them. So equipment, machinery, buildings, land, we can physically use those. We also have intangible assets, which are long-term, and they certainly give us a benefit. It's generally a legal type of benefit, a legal privilege, a legal right. They're not physical because of that. The only physical piece of that is the actual paper that it's printed on. And again, intangible, we're going to record those under that category. Some examples there were patents, trademarks, copyrights, franchises, goodwill. Current liabilities and long-term liabilities, again, when are we going to pay it? Is it 1 year or less? Or is it going to be more than a year? Here's how a classified balance sheet would look. You'll see the breakdown, the categorization. It gives you more detail. It gives you an idea as to what types of assets do you have. So the last couple slides here, we have a couple of important ratios regarding this chapter. The first one we have is profit margin, which deals with what percentage of every sales dollar that we have comes to us in net income. In other words, we take the sales, we pay off a whole bunch of expenses, and we have net income left over. What percentage of the net sales is left in net income after subtracting out all those expenses? So it's net income divided by net sales. It always has to be less than 100%. It certainly can never be more than 100%. It doesn't make sense to have more income than you did sales. That just can't happen. And it never makes sense to have 100%. The only way that would happen is if you had absolutely no expenses, which would be great, but it just isn't realistic. So your net income is going to be less than your net sales. Thus, your profit margin is going to be less than 100%. The current ratio, this is where the classified balance sheet comes into play because we need to know current assets and current liabilities. For the current ratio, we're taking current assets divided by current liabilities. We're basically looking at our risk for the company. How well are we able to pay off our current liabilities with just our current assets? So if we have these bills coming up within less than a year, we better have some assets that we can use up within less than a year to pay them. And that takes us to the end of the chapter. So thank you for your time, and I will talk to you in the next session. In this section, we're going to go over the assignment for week 3. And with this one, we're dealing with the adjusting entries. So you'll see we have 4 different parts to this particular assignment. So if we read through this, it says Meyer Company follows the practice of recording prepaid expenses and unearned revenues in balance sheet accounts. Now the good news is that's what we've been doing throughout this chapter. It means that we're going to record them as an asset for prepaid expenses and a liability for unearned revenues. The end of the period is December 31st, and here's the information based on the adjusting entries we need as of that date. So we're going to see quite a few pieces of information here. The office supplies account, then it says the insurance policies. So we're going to go through this and see how everything relates to the adjusting entries. And we're going to do it A through F. So we'll use each of those pieces of information individually or independently as well. So number one, use the information to prepare adjusting entries. Assume that reversing entries aren't made, but the good news is we haven't been talking about those throughout the chapter either, so you can kind of ignore that. Basically make the adjusting entries as we were taught during this week. So A, the office supplies account started the year with a $43.75 balance. During 2011, they purchased 18,069 more supplies, and at the end of the period, they have a total of $38.50 left. So what this basically means is if you take $43.75 plus $18,069, that's how much office supplies we had that we could have used up during that period. That gives us $22,444 that we could have used, but then we ended up with $38.50. So that means we used the difference, $18,594. We use that up. So we debit office supplies expense, credit the office supplies asset. B, an analysis of the company's insurance policies provided the following facts. So we have 3 different insurance policies. It tells us how many months for each insurance policy, and it gives us a total cost. And down below it says the total premium for each policy was paid in full at the purchase date, and the prepaid insurance account was debited for the full cost. Year-end adjusting entries for prepaid insurance were properly recorded in all years. No real new information there. What we basically need to know is for this year, 2011, how much insurance do we need to recognize? So the first thing we need to do is figure out how much of 2011 was covered by these policies. And of course, how much monthly is the policy itself. So if we take a look here, we'll go down the line, $11,400 divided by 12 months. That gives us $950 per month. April 1st, 2011, that policy, $10,200 divided by 36, gives us $283 rounded down. And $9,000 divided by the 12 months gives us $750. So for 2011, if you look at April 1st, 2010, that's going to be good all the way through March 31st of 2012. So it's going to cover all of 2011. So basically there'll be 12 months of that policy times the rate we calculated a bit ago. For April 1st, 2011, it's going to go out for 3 years. So it's certainly going to last the rest of 2011. But we've already had 3 months, January, February, and March, that it did not cover. So it's going to cover the remaining 9 months of that year times the rate we calculated a bit ago. For August, it's a year. It's going to last us all the way through the rest of 2011 and into 2012. So we have August, September, October, November, and December. We have 5 months of coverage times the rate we calculated a bit ago. You can set up a third column there or another column there, and once you multiply those and add them up, that's where you're going to get $12,000 of insurance expense used up. So we debit insurance expense and credit prepaid insurance for that amount. C, the company has 15 employees who earn a total of $28.50 in salaries each working day. They are paid each Monday for their work in the 5-day work week ending on the previous Friday. So now we need to assume that December 31st, 2011 is a Tuesday, and all 15 employees worked the first 2 days of that week. They worked Monday and Tuesday. That's the end of the period. It says because New Year's Day is a paid holiday, they will be paid salaries for 5 full days on Monday, January 6, 2012. The good news is we don't care about New Year's Day. We're concerned with December 30th and December 31st, Monday and Tuesday. So we want to know what salary to accrue for those 2 days. So really all we need to do is take the $28.50 times 2, and we get $5,700. So we debit salaries expense for that amount, credit salaries payable. D, the company purchased a building on January 1st, 2011 It costs $760,000 and is expected to have a $45,000 salvage value at the end of its 25-year life. The good news is they already calculated annual depreciation for us. We could have calculated it based on the formula we learned earlier in the chapter, but they already gave us the amount. So there's really no calculation needed. You pull the $28,600 down. You make sure we debit depreciation expense for that building, and then credit the accumulated depreciation for that building as well. E, since the company is not large enough to occupy the entire building it owns, it rented space to a tenant at $2,400 per month starting on November 1st, 2011. The rent was paid on time on November 1st, and it was credited to the rent earned account. However, the tenant has not paid the December rent. The company has worked out an agreement with the tenant who has promised to pay both December and January rent in full on January 15th. They've agreed not to fall behind again. We're concerned with December 31st. What rent do we accrue for this particular month? That's our adjusting entry. The rent was paid on time on November 1st, and it was at that point it was credited to rent earned. So that's already been rent earned. It's not prepaid, it's not unearned, it's nothing like that. It's not accrued rent. So that one is not an adjusting entry. They haven't paid December rent, so we haven't recorded an entry yet, but we need to adjust for the fact that we've earned that money because the time has passed. Even though we haven't received it, we've earned it. So it's $2,400. And what it's going to be is it's going to be the accrual entry, the accrued revenue. We debit the account or the rent receivable, and we credit the revenue account, rent earned, or just rent revenue. In this case, they call it rent earned. F, on November 1st, the company rented space to another tenant for $2,174 per month. That tenant paid 5 months' rent in advance on that date. The payment was recorded with a credit to the unearned rent account. So they've given us 5 months, 5 times $2,174. So that's what we'd want to record there. We'd record $10,870. Oh, I'm sorry. That $10,870 would be the full 5 months. We're making an adjusting entry for the amount that we have not actually earned yet. Take that back. We're adjusting for the amount we did earn, the 2 months out of that 5 months. So we did earn November and we did earn December. So we want to count that as earned. $2,174 times the 2 months is $4,348. So it was in the unearned revenue. It was credited to unearned revenue, but now we've earned it. So we debit unearned rent for that $4,348. And we move it over to the rent revenue, the rent earned in this case. Requirement 2 says prepare journal entries to record the first subsequent cash transaction in 2012 for parts C and E. So C was the salaries expense. So what they're basically saying is we're going to pay them for 5 full days on Monday, January 6th. But remember, we've already expensed 2 of those days. We've already expensed them and set them up as a payable. So now we have 3 additional days. It's a 5-day work week. So we have 3 days we need to count an expense for, and the other 2 days we just need to pay off, period. So first let's take a look at it. It's $2,850 times 3 days gives us $8,550 that we need to actually expense. $8,550. But we're not paying for just 3 days, we're paying for the full 5 days. That includes that $8,550 plus the $5,700 that we actually already accounted for up in C. And that gives us a total cash payment of $14,250. Let's see, the other one was E. That was the unearned rent. So on November 1st, the company rented space to another tenant for $2,174 per month. We already handled 2 of those months, and now we're, what'd they say, for the first subsequent cash transaction. Oh, I'm sorry, it was E. I'm looking at F. It was E. So we rented the space, it was paid on time. This is one where they fell behind. So they're going to pay both December and January rent in January. So we're going to receive 2 months, which is $4,800. One of those months we've already counted as rent earned in December, so we set up a rent receivable. Now we're actually receiving it, so we have to reduce it with a credit. The other month is now rent revenue. We're now earning it. So we credit rent earned. It's a revenue account. We get our $2,400. So that takes us through part one. If we move to the next part, they give us a similar type of question. We're still dealing with adjusting entries here. If the computer will work. Okay, there we go. So we have the adjusting entries. Watson Technical Institute provides training to individuals who pay tuition directly to the school. WTI also offers training to groups in off-site locations. Its unadjusted trial balance as of 12/31/2011 follows. WTI initially records prepaid expenses and unearned revenues in balance sheet accounts, which the good news is that's what we're used to. That's what we've talked about. So we make our adjusting entries through A through H. We'll look at each one individually. And keep in mind, in some of these cases, we need to go down to the unadjusted trial balance to look at the balances. A, an analysis of the insurance policy shows that $3,300 of coverage has expired. The good news is that's the entry we need. $3,300 has expired. It was originally in prepaid insurance, and now it's been used. So we debit insurance expense to use it up, and we credit prepaid insurance to reduce that amount. B, an inventory count shows that teaching supplies costing $2,900 are available at year-end 2011. That's not the entry we need. That's what's left. We need to know how much we used. So if we take a look at the balance sheet, we had teaching supplies of $13,000. So we had $13,000 in teaching supplies, and now we have $2,900 left. So we must have used up $10,100 of those supplies. And as you can see down here, that is our journal entry. We debit the expense, teaching supplies expense. We credit teaching supplies asset. C, annual depreciation on the equipment is $12,300. The good news there is that is the entry. $12,300 debit and credit. Make sure to debit your depreciation expense for the equipment and credit accumulated depreciation for that same equipment. D, more of the same, annual depreciation on the professional library. So the key thing here is it's a different asset now, $6,300. Debit and credit $6,300. Make sure to pull down the professional library this time for both the expense and the accumulated depreciation. E, on November 1st, WTI agreed to do a special 6-month course starting immediately for a client. The contract calls for a monthly fee of $2,500, and they paid the first 5 months' fees in advance. When the cash was initially received, the unearned training fees account was credited. So unearned, that's a liability. The fee for the 6th month will be recorded when it's collected in 2012. So we're at the end of this year, 12/31. We want to figure out how much did we earn. We earned November and we earned December. We need to move it out of the unearned training fees, the liability, and into revenue. So $5,000, 2 months at $2,500. So debit and credit $5,000. We debit unearned training fees, the liability, to reduce it. We credit the revenue called training fees earned. The key thing here is make sure to pull down the right account name. We have another one similar. On October 15th, WTI agreed to teach a 4-month class beginning immediately for an individual for $3,300 tuition per month payable at the end of the class. So it's not payable until the end of the class. That's the key thing. The class started on October 15th, but no payment has yet been received. WTI's accruals are applied to the nearest half month. and they give you a hint. That means October recognizes 1/2 month accrual. So this is an accrued revenue type entry. We need to accrue this revenue. We need to accrue half of October, all of November, and all of December. So it's $3,300 per month times 2.5 months. Gives us $8,250. We're debiting accounts receivable because we're going to be receiving it in the future, and we're crediting tuition fees earned. Now, the key thing here is they call this tuition, where they call this other one training fees. So make sure to pull down the right account. G, WTI's 2 employees are paid weekly. As of the end of the year, 2 days' salaries have accrued at the rate of $400 per day for each employee. At the end of the year, so 2 days' salaries, it's $400 per day per employee. So $400 times 2 employees times 2 days gives us $1,600. We debit salaries expense, credit salaries payable for this accrued salaries entry. H, the balance in the prepaid rent account represents rent for December. So they don't give us an amount here. We have to look down here. We find that the prepaid rent was $2,300. What that means is we paid for this ahead of time, and what's left is December's rent, which we're now finally using up. So in other words, we're using up $2,300 of prepaid rent. Now it's at zero. We debit rent expense for $2,300. We credit prepaid rent to reduce that asset. Number 3, this is just one of those things you want to make sure to take the time to do right. So we start with the unadjusted balance. These are always going to come from the unadjusted trial balance. You want to pull all these amounts down into the unadjusted balance column. Make sure it's on the proper side, debit or credit, left or right. Some of these accounts won't have an entry. Notice that there's plenty of space to put several entries in. I think all of them have at least 2 entries. But what you'll find is that some of them are going to be blank. Some of them don't have adjusting entries. Those that do, you'll want to pull down the proper reference. So which line did it come from? Put the proper amount in. Debit, if I can get into this view. So debit or credit, the proper amount. And then notice it'll actually calculate your adjusted balance for you. So that's the good thing. You'll do that for all of the accounts. Quite a few of them it'll take a little bit of time to go through. Just make sure to pull them down, put them in the right place. And then 3.2, we're preparing an adjusted trial balance, which simply means, notice it gives you the order of everything, all the accounts. You're just pulling that final balance from each of those entries, putting it in the proper column, the proper amount. It foots the totals for you. Now, requirement 4 is all about preparing the financial statements. So with 4.1, prepare the income statement. The only thing we're doing here is pulling down balances from the adjusted trial balance. So for revenues, you want your 2 revenue accounts. You want all of your expense accounts. And that'll give you your total revenues, total expenses. You'll need to calculate your net income. With that net income, you pull it over to the retained earnings statement. Notice, here's the key thing. You want to take your retained earnings from the adjusted trial balance, and really it's going to be the same for the unadjusted trial balance. You'll pull it from up above. You add in your net income from the income statement. That'll give you a subtotal. You subtract out your dividends, which is going to be pulled from the adjusted trial balance again. And the key thing here is the retained earnings at the end of the year. It's going to calculate it for you. This should not match up with your adjusted trial balance. It's after all these adjustments to it. Net income minus dividends. And here's kind of connected to that piece. We go to the balance sheet. You pull in all of your assets. Make sure to put the amounts in the proper area, and for example, the accumulated depreciations need to be negative. Pull down your liabilities, and then you have your common stock. All of these up to this point will come from the adjusted trial balance, but your retained earnings is going to come from your retained earnings statement. Don't try to pull it from your unadjusted or from your adjusted trial balance. Don't pull it from any trial balance, because that'll cause your balance sheet not to balance out. This retained earnings has to come from your retained earnings statement. Your check figure will be making sure that assets balance out to liabilities and equity. If they don't, you have a mistake somewhere. And that takes us through this problem for week 3. Hopefully this helps to clarify some of those points, but if you still have any questions, feel free to let me know, and I'm here to help. Thanks for your time.